as George mentioned earlier, it's a little bit of a shift in the title. So we call it Rising Tide, What's Ahead in the Fats, Oils, Greases Market. Subtitle, Big Demand is Here, the Effect on Inelastic Supply. Um, Jumping right in, I guess I should say quickly, methodology. We get this question a lot. How do you determine your prices? How are you different from other price reporting agencies or government organizations? All I can speak to is how we do things. And I talk to buyers, sellers, traders, brokers, people involved in the market, anybody with market information, and find out what's happening on a daily basis. And from there, we come up with our price. We have a multi-tiered pricing structure where actual trades that are verified by counterparties are the dominant price that gets reported in our price guides. In the absence of physical trades, we take bids and offers. Those need to be made to the market as a whole. And there are also instances where there are price assessments. Again, the bulk of our prices are actual trades that have been verified by counterparties. We align ourselves with IOSCO principles. We've done an IOSCO audit, and we're going to continue to do that moving forward. So, for more, if you need more information on that, that's on our site under the methodology link. But jumping right into it, here you can see the beautiful Chicago Theater, probably open again soon, filling some seats at limited capacity. And May 2020, what's here is record high prices. So we have gone beyond the '08, the '11 price peaks and hit new record high territory. So here you see uncharted territory. I'm not sure if you can see my cursor there, but we had 55.5 cents was the weekly average previous record high. It was 56 cents for Chicago Packard BFT last week. Choice white grease is near an all-time high out of the Missouri River market. Poultry fat, used cooking oil, distiller's corn oil, all either at or near all-time record highs. And something I want to point out is it's not just the prices themselves, because they're chasing the soybean oil market, the corn oil market. We'll get into that a little bit more. But it's fat is also becoming more valuable. The FOGs just, for simplicity's sake, have become more valuable relative to corn and to soybean oil. And those have traditionally been the measuring stick for the market. Corn, has application in feed usage. And so you'll see feed get substituted, or corn gets substituted into diets when fat becomes a little too expensive relative to corn. Soybean oil, I've always struggled with this one because it's not a great substitute in a lot of areas where fat gets used, but for the purpose of contracts or potentially hedging, you can have a plus minus there. But we've seen that become more valuable. We've seen fat become more valuable. So here on the left side of my screen, and yours as well, you can see where there's kind of an initial level. That's pre-biodiesel. Things are heavily trading into the export market, into feed, into oleochemical, a variety of other smaller market uses. And this is a time where used cooking oil really wasn't thought of as used cooking oil, it was yellow grease. I'll just give a quick note on that. Yellow grease is it's a max 15 FFA blend. It can be animal, vegetable, it can be high acid poultry fat mixed with waste oil from restaurant grease. It maybe has a little choice white in there. It can be a number of different things. It's just it's a catch-all term for a high acid fat product. Used cooking oil, specifically that. It's waste oil that's collected from restaurants or industrial cooking facilities. And it's refined, cleaned up a bit, and it can be used in a variety of different applications, but primarily it's used in renewable fuels production. And that's because of the low carbon intensity score and the incentives that are attached to that used cooking oil. But going back into this chart, this is pre-biodiesel, or the infancy of biodiesel. You see prices here. They averaged 2005 to 2010, 73% of the price of soybean oil for BFT, and BFT averaged 405% of the price of corn, which is what people still kind of refer to as the should-bes. Getting into the biodiesel era, we see prices hit another tier up. You have 89% of soybean oil that average, and you go up to 412 on corn. Full swing biodiesel with the addition of renewable diesel demand, both in the US and globally, we see that price shift up to 92% of the price of soybean oil and up to 442% of the price of corn. So it's not just the feed, soybean oil market anymore. It's got a lot more applications, and I think that's largely driven by credits That's largely driven by which are fueling the renewable diesel demand. That's the blender's tax credit, that's LCFS credit, as well as the required volumetric obligations that come with the programs. And I think those, here's just a kind of a look back at the market 2003 to 2021, back to the reference of the all-time highs. We have 2008, 2011 in here, and then back to 2021. Again, credit prices have helped fuel this. I just referred to that. We've seen RIN prices at all-time highs. Bob talked about that a little bit this morning. The HOBO spread, the difference between soybean oil and heating oil, has gotten to all-time highs as well. So the RINs are doing what they're supposed to be doing, which is bridging that gap, and that's allowing prices to come higher on feedstock from the renewable fuel sector. The lower CI score in California, the threshold drops year after year to incentivize the use of more renewable fuels, means that more gallons can go into that market, and that incentivizes the use of more feedstock. So that's also contributed to some of these. But ultimately, soybean oil is, again, kind of the bellwether. It's the measuring stick, and you're not going to have 66-cent soybean oil and 35-cent bleachable fancy tallow or 20-cent yellow grease used cooking oil. And Tori will get into this. It's his expertise on what's driving that soybean oil market. But again, there's South American weather, there's logistical issues, there's big Chinese demand, and there's a rebounding economy coming after a year of slumping. I literally had to dust my jacket off today because it had been in the closet so long I hadn't used to wear it. And so that's a good metaphor, I think, for the global economy as a whole. Things are being dusted off. People are, out there getting going, and that's driving demand for a lot of products. In addition to tight stocks, and there's not as much of it around. So we're seeing this surge in prices. So the question is, like I said, rising tide. That's the tide, I suppose, is the soybean oil. The boats are the fats, oils, and greases that are being elevated along with it. Can these prices be sustained? A couple things to look at. The bullish, the bearish side of this outlook is prices still have upside relative to soybean oil, particularly cash soybean oil. We've seen cash soybean oil bases explode over the last 6 months as renewable diesel demand has come into the market and really driven prices sky high. Again, we're in recovery mode. We're seeing increased demand across a lot of sectors. Supply is expected to be a little bit tighter, and I'm going to get into these factors a little bit more in the following slides. On the bearish side, putting on the brakes a little bit, we're expecting some short-term downtime at a few major demand points as part of this growth process into bigger renewable diesel capacity and feed demand. And it's starting to, prices relative to corn's, tumbled a little bit post-WASDE. We're seeing a little pushback from the feed sector, and that could act as a drag on prices, create some volatility and potentially some wide spreads. And again, credit prices and fuel sales. Strong credit prices help push prices higher in the fat market, oils, greases, but they have come off a little bit on some uncertainty over RVOs. Bob talked about that a little bit this morning, and that could act as a kind of a governor on this market in the short term. So getting back into it, relative prices to soybean oil. Here you see the trend of the market over the last year. It's fairly choppy, relatively steady, but you see this big drop in April. Now, what happened was soybean oil prices skyrocketed at the start of April. And at the same time, fat prices either maintained a status quo or they traded lower. And actually, they traded lower in a number of instances. And a big reason for that, I think, was some concern over LCFS credit prices. You saw heavy trading in that market. Credit prices went lower. Buyers pushed back on feedstock values. But additionally, I think what really happened, the credits were a big part of that, but there was some downtime. There was a major demand point went down. Another major buyer in the market stopped purchasing. And so when that news is out there, buyers realize, hey, we don't have to compete with two gorillas. We can, set our prices, and they were able to successfully push stuff off. Additionally, there were some bottleneck issues. It created some short-term buying availability. We saw distillers' corn oil prices tumble as a result. It created some really good buying opportunities out there. And so prices relative to soybean oil became very Very valuable. I mean, this is here at this left end of the chart, you see the low relative prices. That's kind of not in the throes of the COVID pandemic, but a little bit later on, definitely COVID affected and cheaper prices. Went back to those levels, again, driven by that downtime and some buying opportunities. But because of this, there is a lot of reason for prices to keep moving higher. I think we'll see sellers push gently to get these levels higher and higher and higher back to levels that we saw January, February, March. Not necessarily up to, in the case of BFT, 105, 100% of the price of soybean oil, at least in the near term. It's not uncommon to see that in the summertime, but there's definitely room to grow. And I think that's a bullish factor for this market moving forward, at least into our conference in August. And again, I'm kind of focusing on the short term here. I'm going to dig more into the longer term when we see everybody in person in Denver. Supply, again, it's relatively tight compared to recent history. At least in the cattle market here, you see a 1% drop is projected May through August in 2021 relative to the 2017 to 2019 slaughter rate. You know, I omitted 2020 just because of all the volatility, the downtime at slaughterhouses affected the cattle harvest, and it's really an anomaly there. We are going to see, or we are expecting to see, a 1.8% increase in the harvest in May through August relative to Jan through April. And that's not uncommon. Actually, that's very common because of the increase in summer demand for meat. You know, people are firing up the barbecues, you have hamburgers, steaks going on, and so there's an increased demand for meat. It's a seasonality in the cattle harvest, and we expect to see that pick up. Here you see a big pickup in June. There is risk for that not to be as high as projected, and the big reason for that is labor shortages. Packing houses in the beef, hog, poultry industry are all very tight. You know, the major meat packers continue to raise wages in an effort to attract workers. A lot of people blame unemployment payments. I think that there could be stricter rules on hiring that are affecting staffing some of those plants as well. I don't think it's entirely unemployment related, and so it's taking a lot to attract workers into that environment. And not only there, but getting to work Monday through Friday, in addition to Saturday kills, which are needed to get to that capacity, get to the 660 plus levels on a weekly basis in the cattle industry. So we're expecting to see, again, tight supplies relative to recent years, an increase relative to the prior 4 months, but there is a risk for that number to move lower as staffing issues persist. Here we see the same thing with the hog harvest. It is a pickup, 2.7% over the 2018 to 2019 average. There is increased capacity that has helped expand the hog harvest in the last couple of years. Again, 2020 isn't factored into this because of the anomaly here. You can see that big dip, COVID related, in 2020. But the harvest is expected to drop just under 4.5% in May through August relative to Jan through April. Again, part of that seasonality, but the labor issue comes into that as well. Again, these plants are just having a hard time staffing the floor with enough labor to process to the level where I think that they would like to, particularly given the strong meat demand that's out there, both pork and beef. And I know cattle margins are very good right now for the packers. The same issue is persisting in the poultry industry. We're seeing tighter broiler slaughter as well. Something else that factors into the supply chain is transportation. Again, truckers, there's a shortage of truckers, so getting cattle, getting hogs, getting poultry into these facilities and then getting the finished product out is a big part. Byproduct demand in some of the other sectors I've heard, there's bigger demand for skins, bigger demand for offal and pork. So the yields are lower as well. So we're seeing less grease come out of these rendering facilities in addition to fewer animals going in on the front end. So overall, the market is tighter in fat, and that is supportive of higher prices in the near term. Distillers corn oil and used cooking oil. We're forecasting an increase in supply for both of those products. Used cooking oil, about 10% over 2020 levels. but not as high as 2019. It's still a slow recovery. We had the first quarter limited activity. I believe distillers corn oil is I think it's 5.5%. We're projecting over 2020 levels, but again, slightly under 2019 levels as ethanol plants were down the first, and not entirely down, but a number of ethanol plants were down the first 5 months of the year. We're seeing some big plants start to refire. EIA data is due out this morning. Last week was the highest ethanol production level for the year. So we're expecting to see that trend continue here in the near term. So better than 2020, but not as good as 17, 18, 19 levels. So supply, relatively speaking, is going to be tighter in the face of stronger demand, but there is some improvement coming in the coming months in terms of additional material hitting the market. Back to the used cooking oil. Obviously, COVID shutting down restaurants or limiting restaurant access has a big part of that supply tightness. Winter collection, seasonally has had a big part of that the first part of the year as well. Some questions have been asked, and I think they're really interesting, and we're going to explore these, is what effect does the high soybean oil price have on restaurant demand? You have large scale operations that can more easily absorb the cost or pass it on to the consumers. But in the smaller markets, for example, I live in the western suburbs of Chicago, there are a number of small, pubs, restaurants, et cetera, that are independent operations. And so that cost, they're going to have to pass it on to their consumers, but they're also going to have to figure out how to absorb that. A few years ago, I gave a presentation in the EU, and there was a really big concern over, well, won't these restaurants with used cooking oil prices just immediately turn over their used cooking oil? It's not really a waste product. They're going to be incentivized to sell their used cooking oil. Yeah, used cooking oil is as high as 59 cents into the Gulf for July. But if you have 2,000 basis points over on RBD soybean oil, that's a big difference. And you might slow down how quickly you're turning that oil over if it's gotten suddenly much more expensive relative to the contract that you may have on that pays a fraction of what that Gulf number may be. So there's a potential for further tightness in the second half of the year, just based purely on restaurant economics. People are out eating more. The summertime allows for more access despite some of the COVID restrictions. But there is potential for some supply tightness there if restaurants are a little bit slower in turning over that oil. Moving on to the demand sectors and what we see coming in demand. I just highlighted the inedible tallow export chart because I wanted to show how we've seen an impact of biodiesel and renewable diesel, what that's had on the U.S. market. Here you can see, and I pick on Singapore because it's a big renewable hub, a big pickup in exports to that country, 2015 and on. The 2021 is annualized from what we've seen in the first quarter, and this isn't going to play out. This export number is going to be higher, and we're going to see potentially lower export numbers for the rest of the world on inedible tallow. But you see more of this product get used internally, and that trend, I believe, is going to continue as we see capacity in the renewable diesel market grow. Sellers historically have had to rely on exports to keep that price elevated. Now I think they can keep the price elevated and the export market has to follow or lose out on the material. We expect oleochemical demand to be strong through the summer on economic recovery, big demand for finished goods there. Feed demand, again, I'm going to touch on that. I talked about that a little bit earlier. That's kind of a wild card. There's obviously a goal, but meat packers are in the business of raising meat. They want to have a certain carcass quality. And so part of that is feeding saturated fat to these animals. So there's going to be a minimum inclusion rate. Some of the smaller operations, however, have started to cut back on their usage. They're really pushing back on prices, and they're really high relative to corn. We've seen corn come off over the last few weeks, again, post-WASDE. And when you have that relative price get out of whack, they'll start to feed more corn into the diets. So we may see that, and I think that sellers are going to want to keep a certain amount of feed accounts active, particularly because there's logistical restrictions. So if you have nearby feed customers that you have a quick operation or a quick turnaround on trucks, you're going to keep that going. So you might see Uh, Yellow grease trade in the low 40s in feed, but could trade as high as the mid 50s into biodiesel because there's some transfer into rail. There's a longer delivery window with bigger volume. And so that's going to create some volatility, some wide spreads in that market. Again, feed demand is a big part of this market. We expect it to drop off a bit, create a lower price there, but there is demand to replace that. So I don't think that feed buyers stepping out of the market is going to drag the entire complex down as a whole, rather create some wider spreads. There's increased competition. Again, those plant issues that were present in April that created the price tumble have been washed out. Everybody seems to be running full steam ahead, and that increased competition has driven prices higher, and I believe will continue to drive prices higher in the renewable sector as well as biodiesel. Both sectors are going to pay up to secure that material so long as they see support from heating oil. They can move their fuel, and they get support from the credit prices. There's where the risk comes in for prices to get a little bit toppy. Is if we see RIN prices tumble, we see LCFS credit prices tumble, and we see heating oil prices level off or move lower. And here I highlighted, watch the palm styrene market. That's something that's critical in the bleachable fancy tallow market. Once that price of bleachable fancy tallow starts to get way out of whack with palm styrene, there is that arbitrage opportunity for palm styrene to come into the market and start it to work its way into the oleochemical sector. So that should act as a somewhat ceiling in the BFT market here in the near term. Prices shouldn't get too far out of line with the Malaysian palm styrene market. I think it's around $10.50 a metric ton today. You need that spread to get over $100 to bleachable fancy tallow. We're not there yet, but if it starts to get there and it looks like it's going to stay there consistently, you may see oleochemical buyers step out of the BFT market and step into palm styrene. And just wrapping up here, I wanted to highlight on the renewable diesel capacity. And again, this kind of hits home that inelastic, big demand, inelastic supply. Focusing in on this 373% growth from 2021 to 2022. That's January. That's over here, all the way up to the far end of the right, axis here. We're expecting almost 2 billion gallons of annual capacity to come online in January. And so that means that roughly 18 billion pounds of feedstock are needed to satisfy that demand to start 2021. There's a little typo there, it's not 2011. And the U.S. fats, oils, total supply of distillers corn oil, used cooking oil, yellow grease, poultry fat, choice white grease, and edible tallow is 14 billion pounds. So there's a 4 billion pound shortfall on this low CI market. We've already seen, and I think Tori will touch on this a little bit later today, but we've seen big soybean oil demand already hit the market. I think these plants, in an effort to get to market, have decided, hey, we don't want to mess with a lot of these low CI things to start with. There's variable specifications. The metals can be off on some of the choice white grease, BFT, some of the products that might have more of a bone or tissue constituency relative to tactile, which is just pure trimmings. We're going to start with soybean oil, and we're going to slowly incorporate these low CI products in. With that stated, there's big growth in the players that can process these things. And so there's going to be increased competition to secure more material. Yes, the 14 billion pounds aren't all going to go into renewable diesel, but this, nearly fourfold growth represents, one, higher soybean oil prices potentially. I think part of that's already baked into the market. And again, Tori will get into that a little bit later. But that rising tide of the soybean oil market is going to lift that, fats, oils, grease market higher along with it. And that increased competition is going to force sellers to give up some of their credit values. I think that midstream players, feedstock producers are going to want to capture more of that credit value. We have the LCFS plus the RINs plus the blender's tax credit, or if you have double counting for exports overseas, the used cooking oil, that's going to start to factor into that price more than it already has. And there's the potential, once we see more of a wide-scale adoption of low CI feedstocks, for these feedstocks to trade above soybean oil, purely based on that low CI score and the California low carbon fuel standard. And I think with that, I'll wrap it up. And George, I'm happy to take any questions that might have arisen.
Okay, Ryan, thank you for sharing that out. Give me 1 second here. We'll be bringing Tim up next. He'll be up here in the next 5 minutes. We have a few questions that popped up, so I'll throw the first one off to you here, Ryan. How much of that 18 billion pounds has to take soybean oil?
How much of the 18 billion has, I think Tori will probably get into that a little bit more, like our projections on what percentage of that feedstock demand is going to be soybean oil versus low CI.
Gotcha. If anybody does have additional questions, go ahead and drop them in. One of the questions, Ryan, I'm not sure if you're able to answer this one. Could you please share out the census codes you use to track yellow, grease, and also UCO flows in and out of the U.S.?
Yeah, I don't know those off the top of my head, but if they can send me an email, ryan.standard@fastmarkets.com, I'd be happy to tell you where we look at, where we're looking for those UCO numbers.
Okay, sounds good. Any other points you want to add before we bring Tim online, Ryan?
To HS codes, I will say those are tricky. The US USDA for exports are one thing, but seeing trade flows from different countries, China, for example, into the EU is a whole different set. So that's a tricky one to track. But I guess to the export, I won't say question, but point, that's also something that we're seeing, this increased competition. There's big demand from Europe for used cooking oil. Obviously, there's big incentives there. So we're seeing most of that East Coast product move across the Atlantic into the EU and into the UK. As demand in the US starts to ratchet up, that's going to create that additional friction between the domestic players that are in the Gulf and westward and East Coast players that are traditionally shipping their stuff overseas. And I think that's going to create some higher prices as well.